Everyone wants a portfolio that makes around 10% a year while they sleep. Here's the honest truth. The math behind that number is real, but most of what you hear about how to achieve it is misleading or flat out wrong. In the next 4 minutes, I'll explain how this actually works, with real percentages, real risks, and no fairy tales. First, where does 10% even come from? Historically, over very long periods, the U.S. stock market has returned about 10% per year before inflation, closer to 7% after inflation. But that number is an average, not a promise. Some years the market is up 30%, other years it's down 20 or 30. In 2008, it dropped about 37%. So 10% isn't a smooth paycheck. It's what you get for staying invested through ugly years. Anyone promising a stable, guaranteed 10% is selling marketing, not investing. Once you accept that volatility is the price, the rest gets much simpler. Now, the core engine. You don't beat the market, you buy the market. A low-cost index fund owns hundreds of large companies at once. When the economy grows, those companies grow, and you grow with them. No stock picking, no predictions, no constant trading. This works because it's boring. Over 20 years, most professional fund managers fail to beat a simple index fund. One thing really matters here: fees. A 1% annual fee sounds small, but over decades it can quietly destroy a huge chunk of your returns. Look for funds with fees around 0.1% or less. Fees don't make noise, but they eat your future. From there, every solid long-term portfolio is built with just 3 pieces. First, U.S. stocks. That's your growth engine. Second, international stocks, so you're not betting everything on one country. Third, bonds. Bonds don't excite anyone, but they matter because they reduce the damage during crashes. Think of stocks as the accelerator and bonds as the brakes. Portfolio design is simply choosing how much gas and how much brake you can emotionally handle. So let's talk actual numbers. Here are 3 realistic examples. If you're young, investing for decades, and you can live with big swings, a growth portfolio could be 70% U.S. stocks, 20% international, and 10% bonds. That maximizes long-term compounding, but the drops can be brutal. If you want growth with less stress, a balanced portfolio might be 45% U.S. stocks, 15% international, and 40% bonds. This is a classic middle ground. And if you're closer to needing the money, a conservative portfolio could be 30% U.S. stocks, 10% international, and 60% bonds. Same building blocks every time. You're just turning one dial. Once it's built, 2 rules keep everything on autopilot. Rule 1, rebalance once a year. If stocks run up, sell a little. If something lags, buy a little. You're just resetting to your target percentages. Rule 2 is the hardest. When the market crashes, do nothing. The investors who earn long-term market returns aren't smarter. They just don't panic and sell at the bottom. Doing nothing is the strategy. This is where time does the heavy lifting. Investing $500 a month for 30 years at the historical 10% average ends up around $1.1 million. You didn't find secret stocks. You didn't predict anything. You let diversification, low fees, and time work together. This is education, not financial advice. Always do your own research, but that's the real mechanism behind the famous 10%.